Welcome to part 2 of the USDA New Lender Training Course for the Single Family Housing Guaranteed Loan Program. The New Lender Training Course consists of 5 parts. In part 2, we will discuss annual, adjusted annual, and repayment income, calculating income from assets, and income verification and documentation requirements. Once you've completed viewing all 5 parts of the New Lender Training Course, you will be ready to complete the required knowledge quiz through the link provided by USDA to your organization's point of contact. You must receive a passing score to consider this training complete. You may take the quiz as many times as needed. Next, we are going to take a look at income eligibility. USDA loans utilize 2 distinct calculations of income. One calculation to determine program eligibility with annual and adjusted annual income, and then one to determine borrower purchase qualification with repayment income. So first, the lender would determine the household annual income, which will include analyzing the income of every adult household member, regardless of their participation in the loan. Next, you can subtract any eligible deductions to determine the adjusted annual income. So this calculation does not apply just to note signers, but to every adult who will be living in the home. The resulting adjusted annual income calculation will need to demonstrate that the household does not exceed 115% of the median household income limit. Once that calculation is made to determine eligibility, then a separate calculation is performed to determine repayment income, which is the income of the borrowers only. The repayment income calculation will determine the repayment ability and affordability for the applicant. You can access USDA's current income limits on the USDA eligibility site. These limits are updated annually. Now let's move on to an overview of each income type, starting with annual income. As mentioned earlier, annual income encompasses the earnings of all adult members of the household, not just those who are note signers. For adult full-time students who are neither the applicant, co-applicant, nor the applicant's spouse, only the first $480 of their income should be counted. If the applicant and their spouse have been separated for at least 3 months for reasons unrelated to military or work obligations, their income can be excluded from the annual income total. Additionally, for adults in the home who are unemployed but actively looking for work, their past earnings should be included. However, if they are not seeking employment, their previous earnings do not need to be factored in. Now let's review what counts as annual income. This includes the total of base wages and salaries, overtime, commissions, tips, bonuses, housing allowances, and any other payments for personal services. Also, add any income from self-employment or rental properties. If there are losses from a business or rental, these do not reduce the income. They are treated as zero. Include any court-ordered payments like child support, alimony, or guardianship payments. Don't forget to add any regular retirement or pension payments. Government benefits and long-term disability payments should also be included. If the total household non-retirement assets are $50,000 or more, you need to include income from those assets as well. We will go into more detail about this later on. This list is not inclusive. Please take time to review Chapter 9 in the handbook to learn how additional types of income are treated. It's important to note that there are a few types of income that are not included in annual income. Those include but are not limited to foster income, live-in aid income, lump sum or sporadic payments, medical reimbursement, MCCs, Section 8 vouchers, SNAP benefits, student loans, GI bills, and unreimbursed employee expenses. As mentioned, the adjusted annual income determines if the household is eligible for a guaranteed loan. So let's take a look at the eligible deductions that help determine a household's income eligibility. Eligible deductions include the following. Households can get a $480 deduction for each qualifying dependent, including those in shared custody situations. Another deduction is for verified child care costs for children 12 and under, based on expected expenses for the next year. Applicants that have not yet placed their child into care or have no evidence to support payments, deposits, or registration fees are ineligible for the child care deduction. Households with elderly or disabled members can also deduct unreimbursed medical costs that exceed 3% of their annual income. Likewise, households with disability expenses that exceed 3% of their annual income may also deduct those expenses. Finally, if the applicant or co-applicant is 62 or older, there is a one-time deduction of $400 available. Now let's walk through a quick example of how deductions can be a crucial component when determining eligibility. In this example, the income limit is $110,650 for the county the applicant is looking to purchase in. However, their current gross income is $117,000 for the year. At a quick glance, it appears they are over the income limits. But wait, let's take a closer look. This household has 3 dependents, so that is a $480 deduction for each dependent. If we subtract $1,440 from the gross annual income, we're still over the income limit. But we're not done yet. We still have more deductions we can consider. The household also has eligible and documented child care expenses of $500 a month for 12 months. After we deduct the $6,000, the adjusted annual income is $109,560, which is below the income limit, and now the household qualifies. Always remember that if at first glance a household appears to be over the income limit, don't forget those eligible deductions. Please note that if a household does not need to utilize deductions to qualify, lenders are not required to verify those costs. We have now looked at annual and adjusted annual income to check if a household is eligible for the program. Now let's examine repayment income. This helps us see if the applicant earns enough to pay back the mortgage along with any other debts. Keep in mind that repayment income calculations usually differ from those for annual and adjusted annual income. When determining repayment income, lenders should include reliable and consistent income, and it must be documented. This helps show not only past earnings, but also helps the lender assess the chances of this income continuing for at least 3 years during the mortgage. Caution should be utilized for applicants that have a documented sharp increase in earnings. A sharp increase in earnings is defined as a 20% or greater variance in income from the previous 12 months. Lenders must determine if an increase is supported and logical. Examples could include a promotion with the current employer, a documented pay raise, an income trend analysis for overtime, bonus, commission, or seasonal employees. Lenders must look at any gaps in employment to decide if the income is stable and dependable. The agency does not set specific rules on what counts as an acceptable employment gap. It is up to the lender to review the employment history and determine stability. For repayment income, non-taxable income may be grossed up by 25%, but the underwriter is not required to gross up this income. It is at their discretion. Some basic guidance for repayment income eligibility is a 1-year history for most base wages, bonus, commission, overtime, and secondary employment. A 2-year history is required for most self-employment scenarios, seasonal, unemployment, and expense allowances. Child support and alimony would only require 6 months. Now let's take a quick look at ineligible repayment income sources. This list would include, but is not limited to, foster income, lump sum payments such as inheritances or insurance payments, SNAP benefits, and any kind of unreliable or sporadic income such as gifts. Again, for a more detailed list, please refer to Chapter 9 of the handbook. Non-retirement household assets that exceed $50,000 can influence annual income and consequently eligibility for a guaranteed loan. Therefore, it's important to examine how asset income is determined and the proper way to document it. When the cumulative non-retirement net family assets exceeds $50,000, those assets must be reviewed for annual income purposes. Lenders must review asset information provided by the applicant and household members at the time of loan application. Net family assets with actual earnings will use the stated rate of interest to calculate annual income. Net family assets that do not earn interest will use a current passbook savings rate to calculate annual income. A current passbook savings rate can be verified through the lender's personal banking rates, online website, or other applicable sources. For clarification, net assets means assets that will still be possessed post-closing. For example, if a household currently possesses $60,000 in non-retirement assets and they will be paying closing costs of $15,000, that leaves net assets of $45,000 and therefore would require no further calculation for income purposes. Lenders do not have to list assets on the loan application or the asset and liability section in GUS. They can process the loan or get an automated underwriting decision without considering assets as a compensating factor. However, if the assets exceed that $50,000 threshold, the income from those assets must be included in the income calculation sent to USDA and on the GUS eligibility page. Keep in mind that GUS Accept files do not need income calculations submitted. It's also important to note that asset verification is still necessary even if the amount is below the threshold that requires it to be included in GUS. It is crucial that assets are not overstated when used in GUS or manual underwriting. Overstated assets can lead to incorrect GUS underwriting recommendations, invalid compensating factors, incorrect annual income calculations, and possible fraud. If assets are inflated or miscalculated to get a GUS Accept underwriting recommendation or loan approval, it can affect the validity of the loan note guarantee and loss claim payments. This is an example of when and how to calculate assets to be included in the total household annual income. This applicant has a non-interest-bearing checking account with a balance of $17,000, as well as a savings account that earns 0.25% interest annually with a balance of $24,000. The applicant also has a CD that earns 3% annual interest with a current balance of $15,000. The applicant will use $5,000 from checking towards the purchase of the home. The total of all eligible non-retirement assets is $56,000, minus the $5,000 that will be used to purchase the home, bringing the remaining balance of the assets to $51,000. This is more than the $50,000 threshold. Therefore, an income calculation is required. Let's continue using the example from the previous slide. The checking account is non-interest bearing and will have $12,000 remaining after closing costs are deducted. We will assume the passbook savings rate for this example is 0.25%. This results in $30 of interest. The savings account is earning 0.25% interest, which equals $62.50 of interest. The CD will earn $450. Add these calculations together and you get $542.50 of interest income that must be included in the annual income calculation. Again, the calculation is not required to be shown on the 355521 and not required to be uploaded to GUS for any GUS Accept loans. However, the income calculation should always be retained in the lender's permanent loan file, and the calculation is required to be provided on any GUS refer with caution, or manual underwrites. USDA has taken into account extensive feedback from its lending partners regarding the verification of assets and the differences observed compared to other programs. In response to this input, we have made adjustments. Lenders are now required to utilize the balance shown on the most recent bank statement or the verification of deposit, provided that the date on the verification of deposit is later than that of the bank statement. As a reminder, transaction histories are not a substitute for bank statements in order to verify assets. Make sure you are submitting accurate documentation to USDA and avoid processing delays. As a rule, lenders must investigate all recurring deposits that are not tied to wages or earnings, as well as any non-recurring deposits over $1,000. If a lender has questions as to the source of any deposit, recurring or not, it should be investigated. One main reason for delays in conditional commitments is missing or incomplete income documentation. So let's explore these requirements to help you prevent any holdups in obtaining your conditional commitments. Let's begin with what is required to verify income for a USDA loan. At a minimum, the following is required: one recent pay stub with year-to-date figures, a written VOE, and a verbal VOE within 10 business days of closing. If you are unable to obtain a written VOE, you can collect pay stubs covering 4 weeks of earnings, 2 years W-2s, and a verbal VOE within 10 business days of closing. Lenders may have additional requirements, but this is the minimum documentation required by USDA. Self-employed borrowers will need to submit the following: 2 years of filed and signed personal and business tax returns with all schedules, plus a recent profit and loss statement, or IRS transcripts with all schedules, plus a recent profit and loss statement. Note that the profit and loss statement is not required to be audited. Also required is a trend analysis for the applicant's business and confirmation that the business is operational within 30 days of loan closing. One key part of verifying and documenting income is the IRS transcripts. These transcripts help ensure that all income and asset earnings reported to the IRS are shared with the lender. Lenders need to obtain and check these transcripts before closing the loan and keep them with their permanent loan records. If tax transcripts are not received before closing, it won't hold up the loan closing, but they still need to be obtained and kept with the lender's permanent loan records. If the transcripts reveal any previously unknown or undisclosed income or asset sources, the lender will need to review this information further, which could affect the loan's eligibility. Our policy team has created an excellent resource that outlines various income types and their impact on annual and repayment income calculations. Please take a moment to review Attachment 9A. One of the main reasons files get delayed during the USDA review is due to missing income calculations or discrepancies between the calculations and the supporting income documentation. Additionally, if the lender's income calculation doesn't align with the entry in GUS, it can cause issues. So be sure to verify your figures before submitting your final application to USDA. Here is a way to approach your income analysis and documentation. Be precise in the details. Refer to the numbers as they appear in the supporting documentation. Make sure to record your calculations clearly so that anyone reviewing your work can easily understand how you determine the income. You have now completed Part 2 of the New Lender Training course. You may now proceed to Part 3, where we will discuss credit and ratio analysis.